Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Hello, James.
Hello, Jim. You again?
Yes, indeed.
How are you?
I am doing good, thank you.
That's good.
Welcome to another episode of Enlightened Wealth Strategies.
Yes, a welcome to you too. So today we have a special guest.
I am looking forward to this.
Yes, this is, we're going to talk about structured notes, which is not a traditional investment.
No.
Unlike stocks and bonds, which most people are somewhat familiar with, if not very familiar with, but not so much with structured notes.
No.
How they work, what they are. And so we have a gentleman from Ancorato Capital. His name is Pisoot, and he is with us. And I'm not going to attempt to say his last name, even though he just got finished telling us, because I know what it's like to have my name butchered, even though it's Dijazoo and it's not. I don't have as many syllables as he has.
And I still mess it up.
So,
Pisoot, why don't you announce who you technically are with your last name, please?
Well, thanks. First, thanks, Jim and James, for the invitation to come and join this podcast with you. Again, for the audience here, my name is Pisoot Senethavilay. It's a little bit longer. It's only a short 12 letters and 4 syllables. Not too bad. And I am the president here at Ancorato.
well, we welcome you, and we're really glad to have you because there's a lot I think that we can talk about. But before we do that, other than your introduction, we'd like for you to be able to tell us or give us some of your background, your context, how you got into this, and then maybe we'll ask you some specific questions about the fund, and get into where people can use this particular fund within their overall investment allocation.
Okay.
Why don't we start with your company and how
Sure.
that came about?
Well, of course. So at Ancorato, we are a third-party money manager, and we focus on creating objective-oriented SMAs that utilize structured notes as the underlying assets. Right. Our first SMA started back in 2019. We were doing it for a wealth management firm for their own clients. And then we eventually started morphing that out to other advisors as well across the country. And now since then, we've worked with advisory firms from around the country to provide them solutions for achieving very specific objectives that happen to use structured notes as the underlying assets versus what many people are familiar with structured notes is, buying notes directly. I think we are one of the innovators of putting notes into portfolios where we manage it on behalf of the advisors and their clients versus advisors having to do it themselves.
Okay, that's great. Now, what I'm going to do, if we can, is even just take a step back. What specifically is a structured note?
Well, that's a great question. I think that's sort of the start of all of this, right? Structured notes have actually been around for a very long time.
Mm-hmm.
They started first in the 1980s back in Europe, and then they migrated over to Asia, and then really started coming to the U.S. in the late 1990s, early 2000s. And what's interesting about structured notes is that we in the U.S., we're an emerging market in the entire global structured notes market. It's a $3 trillion industry. And for us in the U.S., we're barely tapping $150 billion of structured notes across the country for investors here through the U.S. And the reason why I think they're somewhat new to the market and just emerging here is structured notes are somewhat of a complex investment tool. They're a hybrid security. They're a combination of a bond mixed with options and derivatives wrapped on top of it. So you mentioned earlier your description about structured notes being different from traditional investments of stocks and bonds. But what also makes them very interesting, though, is that they're a combination of the two. So basically, a structured note is a debt obligation by a financial institution. Call it JP Morgan, Barclays, or whatever the financial institution that is issuing that structured note. What they do is they will wrap a zero coupon bond that might have $1,000 face value, and they'll put some options on top of that. So instead of having $1,000 face value, maybe it's now $900 with $100 worth of options. And depending on the objective of that structured note, the options can either generate income, whether it's on a monthly or consistent basis, based off of the underlying performers of what's called the underliers. Those are the assets that the options are based off of, or it can have a participation rate of some sort if it's a growth note. Maybe it's a 3x multiplier at maturity, or whatever the case may be. But what makes a structured note very unique is that it has a couple features. Number one, because they are bonds issued by issuers, all structured notes have a defined maturity date. So you know that it's going to mature, whether it's 12 months, 24 months, 36 months, 5 years from now. It has a defined maturity date, which I think for many investors, they'd like to know. Hey, let's say you buy stock and you bought Apple 10 years ago. Well, when you sell, you don't know when to exactly get out of or hold on to that particular equity. With a structured note, because it has a defined maturity date, it does it for you. So that takes sort of that thinking off of that plate for the investors and for the advisors. So the other unique aspect about structured notes.
So there's a finite period to it, Pisoot,
That's right?
Okay.
And then the other part about structured notes that makes them very interesting is that they oftentimes will have what's called downside principal protection built in. So if you look at it as a structured note, the underliers, again, are options that are based off certain assets. It could be the S&P, it could be individual stocks, it could be other broad-based indices. And based on that performance, if at maturity date, when the performance of those underliers, now the structured note doesn't technically own any of those assets, it just owns or purchases the options that are based off of those underliers. Based off of the performance of those underliers at maturity, if you have built-in protection, even though at maturity, one of those underliers may have dropped, say, 25% in value from its original start date, but because you purchased a note that has 30% downside principal protection, at maturity, the issuing bank will return 100% of the principal in that scenario. So it has a unique feature. Not only can it pay direct income, have growth, but it also can add some protection against the volatility in the marketplace.
Okay, that's great, because what you're basically describing is, as you said, it could be a hybrid. It's a hybrid investment, but clients can have the opportunity to invest either in a fixed income oriented type of a structured note, or an equity or growth type as well. Now, interestingly enough, I have clients that have invested in individual structured products, structured notes. And in your case, what you're doing is actually managing a fund that consists of this. So how do you do that? Do you, because you mentioned JP Morgan, Barclays, which are all the big financial institutions that issue these notes, and a manager or an individual may go out and buy those, and it probably is smart, or should be on our part as advisors, to make sure that they are not putting all their eggs into one basket with one financial institution, that they are spreading the risk. But is that how you, within the fund at Ancorato, is that what you basically do within the fund?
I think, yes, for us, risk management is probably our first priority, is to do what we can to try to mitigate as much risk as possible. Now, for just clarification, James, one of the things I do want to clarify is that what we provide portfolio management through an SMA format, right? Separately managed accounts. So rather than a fund. So let's say an advisor chooses to use our strategies with their clients, they would simply allocate, to our SMA, a particular portion of the client's account value, whatever the case may be. Let's say the client has $1 million and you want to allocate 10% to our fixed income strategy.
Mm-hmm.
What we would do with that $100,000 is that, number one, to mitigate risk, we don't deploy all that $100,000 into any one note. So the first thing that we do to mitigate risk is we don't allocate more than 6% of that account value, or the $100,000, to any one note. On a weekly basis, we're buying new notes every single week. And every single week, as we buy and create new customized notes, we're going to allocate anywhere from 2 to 6% of that $100,000 to that new note that we purchase. So that's the first way that we help to reduce risk is we help reduce over concentration risk. Now you mentioned something very interesting, which is counterparty risk, the risk of being over concentrated to any one issuing bank. So in a particular strategy, say our fixed income strategy, once we start to reach a threshold of say 15% of active notes being issued through one issuer, we'll stop using that issuer for a while. Now there are over a dozen different high quality institutional grade financial institutions that do provide structured notes. So we have the opportunity to choose other institutions to price our notes and to buy from so that we don't over concentrate to any one note. So within the client's portfolio with us, they'll own anywhere from 20 to 40 different note positions through different issuing banks with no more than 50% to one issuing bank. And again, we'll also spread the risk because just through the natural course of us buying notes over time, they'll also have different maturity dates, basically laddering the dates at which they mature.
All right. So you've taken that $100,000. I give that to you for one of my clients, and you then will invest that on a weekly basis moving forward. So meanwhile, you invested in a note over the next 4 different notes, for example, over the next month. You're saying you put up to 6% or so into that. So let's just assume for argument's sake, at the end of the month, you have $90,000 left. Are you putting that on the sidelines in a cash account that's earning some interest until you do invest it? And then you are looking at in each month or each week, you are looking at other opportunities in these, as you pointed out, the various financial institutions. And again, I assume that they are the large financial institutions that maybe we can call the too big to fail, or do you also look at other financial institutions that might be a rung lower?
No, to kind of answer that backwards here, we're only looking using AA rated or higher financial institutions in their regions, right? Typically too big to fail type of banks, as you called them there.
Yes.
But to answer the first part of your question there, the money that's not invested does sit in a short-term bond ETF, earning approximately anywhere from 4.5% to 5%, depending on that particular short-term bond ETF. So let's say the $90,000 that's not currently deployed does earn some interest. And then along the way, as we buy a new note, we then draw down from that account to then buy. And also, when a note pays its distribution or maybe gets called, the money does go right back into that account. So it goes right back into a short-term bond, again, until we buy it for future deployment.
Interesting. So what I'm hearing from you is that you're basically investing into these structured notes. They're short-term durations, and as they mature, it may take you, well, let's see, 6%. How's that divide out over weeks of 100,000?
At an average of
4%.
Our average note size is about 4%.
Okay.
So that's 25 notes. That would take 25 weeks.
Yeah.
So typically tell advisors and clients to expect anywhere from 6 to 9 months to fully deploy all their capital.
Okay. Well, that makes sense. And then what happens is as they mature, you're automatically reinvesting.
That's right.
What kind of income can a person, your fixed income notes or your SMA, what kind of income can they expect if they're using this portion for some form of income?
Yeah, so we have 3 different income strategies. We have our most conservative income strategy, which we call our broad-based index income strategy. We then have our conservative income strategy called fixed income. And then we have our aggressive income strategy called high income. In terms of our most conservative, which we call broad-based index income, our target is 6 to 9% per year of total return, net of our fees. In terms of our conservative fixed income portfolio, our target is 10 to 15% per year of current income, net of our fees. And on our high income, our target is 15% plus per year of current income, net of our fees. Historically, with our conservative fixed income strategy, we've netted a little over 10.5% per year, net of fees. And on our high income, we've netted over, I think, 16.5% per year, net of our fees.
That's impressive.
That is impressive.
And so I think both Jim and I, our heads go to those clients that, as he mentioned, are looking to supplement and their retirement income or pre-retirement income. So this would be a great tool to provide them with that monthly income, or at least one piece of it. And I think the example you gave, where an individual's got $1 million and you put 100,000, you put in 10% of this. So over the course of a year, now I'm going to take this back. If you invest in this, you mentioned that it could be a year to sometimes up to 5 years for these notes to mature. Is that also contingent upon the three different funds that you're using, the mature dates? Because the reason why I asked that question is that would also have an impact on the overall return. So if we're doing a plan, we would want to get a good sense of what the earnings would be, so that we can say to a client, hey, look, you have a need X, and we're going to fill the void with a fund, an SMA account that provides this income stream. Does that make sense?
The unique thing about us setting to structure this as a SMA versus a fund is that each note shows up on the client's brokerage account.
Mm-hmm.
So every note that we purchase shows up as its own individual QSIP in the client account.
Okay.
So as each note matures individually, it just matures and goes right back into the short-term bond ETF that sits within that same account. So in terms of liquidity, these notes have they have daily liquidity, just like any other bond that they would be used to investing into their class portfolio. Many of the advisors who use our strategies use this either as a complement to their existing fixed income strategy, or maybe even as a replacement to some of their traditional fixed income, because of the coupons they're able to achieve and because it does provide liquidity. I mentioned because these act like bonds with a maturity date for the issuing bank. You can, if there's a note that you want to sell out for whatever reason, you need the funds for other purposes, whatever the reason may be, you actually have the ability to sell these notes back to the issuing banks. And as of this date, since 2019, we have had any issues with it. Again, past performance is never guaranteed future results, but historically, we've never had any issues selling any notes early to one of the issuing banks. Now, what might happen though, just like a bond, if you have a bond with a 3-year maturity and you sell it with 2 years left, you're going to take a discount on that, right? It's going to be a discounted price, and the bank will also charge whatever fee they charge for it. So for us, that's one of the reasons why we like to do a blend of short-term 12 months to some longer-term 36 months, so that if clients need liquidity for whatever reason, we can go out and we can target the notes that have the highest value to par, so that we can sell those out first to achieve some sort of to achieve the level of liquidity clients need, while potentially taking the lowest discount possible. So that's another reason why having a diversified portfolio is a benefit to the clients.
Now, do issuers call back the bonds?
Oftentimes they do.
Mm-hmm.
Now, if you look at income notes, the way that income notes work, an income note works, is that, let's use as an example, right? We buy a note through JP Morgan, and it has 3 broad-based indices, and this is going to be in our fixed income portfolio. Has SPY, NAS, and some other ETF associated with it, whatever the case may be. Each month, one of those underliers has to show a value typically below the par value, but above what's called the coupon protection level, coupon barrier level. Let's say this example is 30% on the coupon barrier. So long as one of those underliers, so long as all those underliers are above that coupon barrier, the note will get paid for that month. And let's assume it's a 12% note paying 1% on a monthly basis. On its valuation date, as long as all of those underliers are above the coupon barrier, it will continue to pay. It will pay its note for that month. However, in order for that note to pay for the duration of the period, let's say the duration for this note is 24 months. So it's a 12% per year times 2 for 24 months. In order for the bank to continue to pay that, one of the underliers has to always be below its original par value. So on the statement, this is the confusing part for many advisors and clients, is that on the statement, it will show a value of, say, $950, even though the original purchase of that note was $1,000. It's done by design so that it keeps paying that coupon of 1% per month. Now, let's say, though, on month 10, all those underliers are performing well, and now its value is above its original par value on the valuation date. What the bank will do in that situation is they will call that note, meaning they'll pay that 10th coupon and then give 100% of the original principal back to the client. Now, no money was lost.
No.
The clients made 10%, right? With that note, they got all their money back, so there's no principal loss. But now that money's sitting in cash again. You have to go to, if you are notified that note got called, you would have to go to redeploy that capital into something else that's earning a similar or better return, or otherwise it just sits in cash, not deployed. So that happens all the time.
Okay, so in that instance, now when that is matured or in this case it was called back by the institution and now it's sitting in cash, when do you find the best opportunities? Because my understanding, and correct me if I'm wrong, is the best time in which to buy these types of notes is when there is a lot of volatility in the markets and the underlying broad-based indices as you described.
Well, that's exactly right. When creating structured notes, it's a bit counterintuitive, right? Volatility is your friend. So let's look at an example of last month here in April. I believe that we would all agree April was a fairly volatile time in the marketplace.
Yes.
Just a pinch.
So last year, 2024, and again, I'm going to use our fixed income just as it's an easy conversation to have. Let's use that portfolio. Last year, that portfolio purchased 46 notes in 2024. That's a lot of notes.
Mm-hmm.
From July of 24 beyond, 16 of those notes got called. So that's a very short window of time that those notes got called, because from July until the end of 24, the market was it was an upward trend. Because they were on upward trend, all those underliers were kept going above par. We had 16 notes get called in a 6-month window. So what did that do? That increased the cash position of those notes. Now, here's something we do not do. Just because there's a large cash position doesn't mean we allocate more than our 6% allocation. We stuck to our rules, consistently bought anywhere from, again, 2 to 6% per note. Just to clarify, here's another rule that we have. Every single month per strategy, we have a minimum that we deploy of 6% and a maximum that we deploy of 25% into any one strategy per note. I know there's a lot of numbers here. I apologize for that.
No, that's
But
understandable.
the reason why we have that is we want to make sure we're always deploying some capital every month, but we don't want to over deploy just because we see a good market. So in April, from July of last year, in our fixed income notes portfolios, we had a fairly large amount sitting in that short-term bond, and we were buying every week. But last month, because of the volatility, we actually hit our maximum allocation of 25% in that strategy. We bought so many notes with a higher conviction. Our average, I said, was about 4%, but in market conditions where there's a lot of volatility that's in our favor, we might increase that to about that 6% allocation, as I mentioned. And then the unique thing about volatility is that not only is it a good time to buy because of volatility, the reason why it's a good time to buy is because the same notes that we were pricing in March or same underliers, we were maybe getting 10, 11, 12, actually because the market was on a steady upward trend, we were actually pricing at 8, 9, 10%. Our goal is try to get 10% or more. So that just wasn't as attractive for us. And then here comes this market volatility in April. And on the same underliers, the same indices, same ETFs we were pricing just 2 weeks prior, now we're able to buy notes at 12, 14, 17, 18% coupon rates with 30 to 40% coupon and principal barrier protection levels. So we were getting better coupon rates at even better protection levels or same up. Actually, better because a lot of those underliers were trending downwards or were at a lower par value than what they were. So that was giving us some great pricing opportunities. And because of that, we were able to hit our max allocation in April of structured notes in that, and actually two of our six strategies.
It's quite impressive.
In April, across all the notes that we bought, the average increase to coupon was over 2.5%. And every note that we bought compared to a month prior and the month prior to that, because of the volatility.
And that's
So that's
that's
2.5%.
substantial. Yeah, that's substantial.
Attractive.
Yeah, absolutely. What is now each of the three funds, is there a minimum investment?
Yeah, for each of our strategies, in terms of, again, we have three categories of strategies, right? We have our broad-based indices, we have our conservative, and then we have our aggressive. The differences first, before I dive into that, is that in the broad-based indices, we're only using broad-based indices as those underliers. Again, that is a form of risk mitigation. In our conservative, we use broad-based indices and sector ETFs, much more predictable, but the sector ETFs, they do add a little more volatility, which then can allow us to get more coupon. And then in our aggressive, we're using individual stocks. So for that risk profile, it's only for those who have, an aggressive risk profile associated with them. The reason why I started with that first, before diving into the minimums, is because the minimums are designed based off of the risk profile. So for our broad-based indices, because it is the most conservative, we have a much lower minimum of only $20,000 per account in those strategies.
Okay.
On our conservative, it's $35,000, and then on our aggressive, it's $50,000 per account.
Okay, that makes sense. So so let's look at the aggressive. When you say it's based on stocks, is it a basket of stocks in the SMA, or is it specific stocks that will be behind the structured note itself?
Yes, sir. Each note in that portfolio will own 20 to 40 different notes. And each note will have a basket of underliers, typically call it 2 to 3 different underliers. I mean, example, in, say, our high income note, maybe it would be Amazon, Target, and let's say Kroger's.
Okay.
We put those three into one basket. You'll notice that there's almost no correlation between the three, except maybe Target, Kroger's. But we do that by design as well. As we're looking at data to create these different, and the majority of our notes that we purchase are customized notes. We're doing all the research ourselves to determine which underliers may have seen opportunities of dislocation recently, but yet have good fundamentals. So we're looking for opportunities with these underliers that have recent dislocations, but have good fundamentals, and we'll use those as we create the notes, because that can then generate us that recent dislocation could create a opportunity for higher coupon rate. So let's say this example, this has a 24% coupon rate, paying 2% per month because it is individual stocks. And let's say I'm just using Kroger, it has had some recent volatility. And because of that, that's created some opportunity for us. So in that particular example, that's just one note though. And then the other 19 notes in their portfolio may have different underliers. I might have, and again, it might have Microsoft or NVIDIA or Raytheon or some other type of, usually when we're looking at underliers, we're going to identify symbols or companies with at least a $5 billion market cap or higher, because we want to know that they have plenty of options available to price against.
Okay, that makes sense. So is it 3 is usually what, 3?
2 to 3.
Okay. And now what process do you go through? It sounds like you probably have to do a lot of fundamental analyses of these various stocks in order to put them on underlying the note itself. So what does that process look like? It's got to be pretty intense, I would think.
It is a very intense process. For us, obviously, as an active manager, we have our own investment team, and this is their job on a daily basis. They're constantly reviewing different underliers to identify, again, opportunities of dislocation. One of the things that we actually also pay attention to is that if we start to use a particular underlier if we start to allocate too much to one underlier, that in terms of having notes active with that underlier, we'll stop using that for a while. Let's say we have in our fixed income strategy, let's say all of a sudden we now start to notice we're at 10 to 15% of our active notes might have SPY in it. We'll stop using SPY for a while because we just don't want to have too high of allocation to any one underlier, even though it might be spread at different issuing banks and paired with different underliers. We just don't want to be over allocated to any one underlier. So our team is constantly not just looking in the market to see opportunities of dislocation across the 3,500 different symbols out there. It's less because we have to have $5 billion or more market cap. But our team is also constantly monitoring our existing notes to see how are they performing, to understand where those underliers are, what the performance of how close to that barrier, coupon barrier, or even principal barrier protection. We're constantly monitoring the activity as we purchase, but also the activity with the existing, so that we can make a tactical decision. Do we want and maybe need to sell an existing note early to mitigate principal loss if there might be, or do we hold a maturity so that we can achieve maximum the maximum benefit for our clients?
So you're doing a lot of, as you described before, risk management, and your approach is highly data driven in order to When was Ancorato founded, and when did you set up the approach that you're using with the SMA?
Yeah, our first SMA that we created using structured notes started in 2019. That was our very first SMA. I think that makes us one of the innovators of SMAs or structured notes in the country, because most advisors, to your point that you mentioned earlier, James, use notes on an individual basis. They'll buy one note or a couple notes and put in their clients' accounts, or they may create their own strategy of buying individual notes for a client's account. Maybe they have their own income strategy, but they're managing it themselves. For us, starting in 2019, that makes us very unique in the marketplace, where we take all the heavy lifting off of the hands of the advisors. In the situation where a note gets called, if the advisor isn't paying attention, they would have to go in and manage all that for themselves. We do that because in our strategies, when that happens, we do it on behalf of the advisors. And the reason really for us doing that way back when was because we were doing it for our own clients. And we noticed the pain points of structured notes when it comes to an advisor. Notes getting called early, having to stay on top of the marketplace, having to make sure that, hey, you want cash available to deploy when the market conditions are right. All of these pain points were things that if you're not actively managing on a daily basis, you forget about it, or you glance over it because it's just not part of your day-to-day function. So we created that back in 2019. And then over the years, we've generated all this data-driven, all these rules, all these data-driven rules, all these core philosophies. I forgot, one of the rules that we look at is, the percentage of breach, right? I apologize.
Okay, that's okay.
Sorry. How historically we put these notes together, what is their percentage of breach, or how often have these underliers broken the barrier at that particular coupon level or a protection level, excuse me. If through our research, we notice that the percentage is higher than we're comfortable with, we just don't buy that note. We don't move forward with it. So again, that's how we help mitigate risk, is what's the probability of breach? Because that is the only time in these notes where there might be a risk of principal loss. And if it's too high, we'll move away from that note.
Jim?
Well, I was just thinking about structured notes and how to utilize it with our clients.
Mm-hmm.
What I see here is potentially something that's at this point more flexible than an individual note that they've created using the SMA. But what would be the downside at this point? Because if you're generating income and the client doesn't have a need for the money that's tied to the note, it sounds like it's a good deal, but there's got to be downside to everything.
Well, I think you're right. But even before we address the downside, there's two ways that you could, capitalize on this. I think number one, if somebody is retired, you can create a pension out of this, right?
Right. Yep.
Okay, number one.
That's what I'm saying.
Pension annuity.
Right.
And or if they're not, this could be utilized within a retirement account because now it's not being taxed because it's high income.
Interesting.
That's a very interesting point to bring up. I do recommend, especially does it because they do provide high levels of income, and these are and the custodian will put these on their 1099s. Most advisors use this within retirement or their qualified accounts for their clients in terms of the income.
Yeah.
On our growth side, though, our growth strategies, which we haven't spoken much about, the majority of our advisors are putting those in taxable accounts because our target is, although we're creating these notes with 4 to 5 year maturity, our target for those notes is to actually sell them early after a year so that it's treated as long-term capital gain.
Okay, that was my next question, which you would have to pick and choose which one of the SMAs you're going to use, and then determine the location, whether it's in a taxable account or a retirement account under the umbrella of being tax deferred.
Well, in terms of picking and choosing, an interesting thing about our strategies is many advisors actually do a combination of. So let's say you have a client, let's use that same $1 million client, and they have a moderate risk profile. Now you allocate $100,000 to our strategies, but then you could go maybe, let's say now you allocate $50,000 into our conservative fixed income, and then the other $50,000 into our opportunistic growth.
Right.
Because now the blend of the two meets a moderate risk profile, but the total return when combined could be in the middle to upper mid-teens in terms of total return per year when you combine the two.
Well, I'll say this: even if we were to do that for a client and get 12 to 13%, they more than likely would be quite pleased with that overall return for that period of time, for sure. I'm not trying to. I'm just being more conservative with the overall return, not to diminish your historical returns in any way. But I do appreciate you pointing that out, is basically utilizing two different SMA approaches and combining it. And that's where my head went. I would even say, for example, if you went to 150,000 and spread it across the 3 different funds.
Now, are you managing the capital gains to make sure that the gentleman or the aggressive one is handling the capital gains properly in those non-taxable accounts, or is that our responsibility?
That's the responsibility of the advisor and their clients. Correct.
Okay.
So for us, our goal is to target, again, that underlies that we believe can have some appreciation within the next 1 to 2 years, even though the note might be a 4 to 5 year duration, because our goal is to sell early. In our aggressive growth strategy called opportunistic growth, that's been open since 2020. The total annualized return since we started that has been a little over 36% per year. Now, again, past performance is no guarantee of future results, and that is not our target.
Right.
Our target is 20% per year or higher total return. 36% is not sustainable. Let's just be 100% clear on that, right? Our goal is in that 20% plus. Here's an example of a note that was in that strategy. There's a note that we bought that was based off of gold and XLE in March of 2022. By February of 2024, last year, that note was actually trading at a 49% premium above par.
Wow.
This was a 5-year note. So that means 2 years in, it was already trading 49% above. The way that particular note worked was at maturity at 5 years or 3 years after, 5 years, excuse me, it had a 4.5 times multiple on the growth of the worst performing asset. So let's assume if that note went to maturity and the worst performer of those two grew by 20%, you now multiply that by 4.5%. That would have been the total return, which is pretty amazing. But in this example, the value of the note was trading at 49% above par. So our investment team had to make a decision. Do we sell now and take advantage of this growth today, or do we wait 3 more years to see what happens? Our investment team chose to take bird in hand.
Mm-hmm.
We sold the note. We actually priced it out And in 2.1 years, we actually got a total return of over 50% to our clients. So that averages about 25% per year. And that's really what we're trying to do here. We're trying to achieve right around that 20% plus mark per year for our clients and looking for opportunities to do that with different notes.
Now, do individuals have to be an accredited investor or not?
They do not. The beauty about structured notes is because they are liquid, because they trade and are issued by issuing banks and they show right in a brokerage account. There is no accreditation or other investor qualification rule here.
Good. That's great. I kind of assumed that and knew that, but I want to point that out because I think that's invaluable information for people, both clients and other professionals alike. So one other thing too, Pisoot, you mentioned, in conversations that we have had in the past, that you have built like a strategy link as a turnkey solution for advisors. Have you mentioned that at all, or do you want to give us some specifics related to that?
Oh, yeah, well, I would love to mention that. Thanks for bringing that up. You know, one of the challenges of an SMA is the nature of an SMA. An SMA is called a separately managed account. So let's say you have that same client for $1 million and you want to allocate $100,000 to us. The traditional process with an SMA is that you'd have to go, let's say there was Schwab. You would have to go and open a second account, take out $100,000, move it to that second account, and then put us on as a sub-advisor of that new account. Your client has to sign new account paperwork. They have to sign another LPOA. And now you as the advisor have to manage two separate accounts for this one client and bill two separate accounts.
Correct.
For most advisors, that's just a process they don't want to do, especially not for a smaller account. They may do it for a $10 million client, but for a smaller account with $300,000, $400,000, it's just more of a hassle than it is anything else. So what we've done is we've partnered with a fintech company, and we've created basically this what we call white label TAMP that we call StrategyLink. And the way that it works is, let's say you're an advisor and you're on the Schwab platform, we can connect directly to your FA master. When I say we, I mean our fintech company connects directly to our FA master. And once we've connected to that master and the accounts that you've selected, your client accounts have been also tied to that, you can log into our StrategyLink portal and simply allocate your clients to our strategies without ever having to open a second account, without having to sign another LPOA. There is literally, for the clients, it's a seamless transaction. They never see anything except a notification from Schwab that this has occurred with nothing they have to do.
So it would be no different than if Jim and I had our client's account. It's $1 million account, as you just described.
That's right.
And we wanted to purchase Apple or any other security. We would do the same exact thing effectively.
That's right. Once StrategyLink has been tied to your Schwab account, you can then log into our portal and allocate to us. And then, like I said, in that example, you protect $900,000 of the other assets, Apple and whatever the equities you own, or you protect $900,000, and then you unsleeve $100,000 for our strategies. And then within our portal, you just choose how you want to spread that $100,000. And then we handle the rest after that.
Okay. Does that make sense, Jim?
Makes sense.
Now, I'll say that I just as a caveat, the process of connecting StrategyLink to the custodian sometimes can take time, right? It's at the end of the day, we're at the mercy of the custodian. But once it's connected, it is seamless for the client.
Now,
every note that they own shows on your existing report for them. There's nothing else. Nothing shows as Ancorato. Everything shows under your brand and your identity.
How does one go about setting up that connection?
Well, that's a great question. Obviously, reach out to us and we'll work directly with you and your relationship manager at your custodian to get them connected. And we'll get the relationship manager with our fintech platform, and they really do all the work behind the scenes. It could take a couple of weeks, it could take a couple of months. It all depends on the speed of the custodian.
Okay. Where do you see the structured notes this sub industry basically going in light of where as we talked about earlier, that in April it was very volatile, and so that actually works in our favor. But moving forward for the next several months into the second half of the year, where do you foresee things going? And I don't expect you to be a prognosticator, but in general.
Well, my crystal ball tells me, James. But I do believe that we're already seeing it now. We're already seeing a much larger adoption rate by advisors here in the U.S. using it with clients. So that's already happening. The question is in what format? And the structured notes are constantly evolving. Structured notes are simply an engineered product by issuing banks, whatever the case may be. And they're always issuing new structures all the time. So what advisors are finding, once they fall in love with structured notes, they're starting to notice that keeping up with the new trends of notes is actually quite complicated because there's constantly new trends all the time. So I do believe that there will be more managers like us who are putting our strategies together in a format that makes it much easier for the advisors to offload that work to somebody else or to create new fund strategies or ETF, whatever the case may be. But the future adoption of structured notes, in my opinion, will be through the use of managers like us versus advisors doing it individually one by one.
Okay.
Because it is a lot of work. I was actually at a conference last week, and there's a firm, an advisory firm that uses a lot of structured notes. But when we describe to them the process that we manage, number one, it already aligned with everything they believed in terms of how they manage risk, in terms of what the objectives are they want to achieve for their clients. So because we're already aligned with their goals, their beliefs, and their risk management, their goal is how do we then use you? Because they have 2 employees where 50% of their day is just managing structured notes rather than going out and gathering new clients, building relationships with existing clients, collecting more of the wallet, right? So now they realize that there's other groups out there like us at Ancorato who can manage this portion for them so that they don't have to. And I believe the future of adoption with structured notes will be through that format.
Well, so what you're basically saying is that for an individual advisor or smaller firms to try to manage this themselves is highly labor intensive. And so you're doing the heavy lifting, and it will allow them to free their time up to manage their clients in other ways.
That's correct. I mean, unless you are a portfolio manager and you love watching the market every single day to see what opportunities come up, and you love spending your time looking at a computer screen versus being with your clients, hey, then maybe it's suitable for you to do it yourself. But I would say, I'm going to assume that 80% of the advisors who I know and work with out there do not want to do that every single day. And they'd rather spend time understanding what their clients are looking for and looking for solutions that meets their clients' objectives and building their book of business versus that.
Yeah, I think Jim and I are on that side of the aisle because, well, structured notes are, I'm certainly familiar with them and I see the value and the benefits of them. But just to, as you described, to keep up with it can be a full-time job in and of itself. So I don't know that either one of us want to dedicate that amount of time to it. We want to bring other solutions and other strategies to our clients, and I do think that this would be something that we absolutely would want to bring to their attention. Having said that, so I know that you and I have spoken over the past many months, and I do think that in order to perhaps bring this to the attention of clients and other professionals, if we wanted to have a conversation with a prospect and or a client, we can do that with you too, correct?
Correct. Yeah. Whether it's usually myself or we have our capital markets team as well. They're happy to jump on a call, jump on a Zoom. If they're in your local area, they're happy to meet with you and your clients. We're happy to discuss and share our strategies as it relates to structured notes and the market thereof. Because we believe that the future of adoption is not just obviously advisors using strategies like ours, but educating the marketplace as well.
Okay.
In terms of education, you can actually go to our website at ancoratocapital.com. We have a section called Educational Resources, where we have a Structured Notes 101. It's a PDF that just talks about that from a very high level what structured notes are. We have a video section that describes how structured notes work. Remember, what I mentioned before, one of the most confusing thing about income notes to clients and individual investors is that they always look like they're priced below the original purchase price. And they forget that it's by design. We have a video that describes exactly that so that you don't have to. So that, again, our goal is to support the advisors in any possible way and educate those type of education resources, meeting 101, whatever the case may be, is how we know that we can support you.
All right, that's great. How big is your team over there?
We have a team right now of 17. The majority of our team right now on the investment side. We are growing our capital markets team. Our capital markets team is 4, but we're looking at adding a couple more people here. So our goal is to be able to service the entire nation on a quick, with as much expediency as possible.
That's great. Now, one thing we didn't ask you from the outset, maybe you could explain how the company arrived at its name.
That's so Ancorato means anchored in Italian. Hence, you'll notice the anchor on my shirt and on my background here. But we were creating the name. I think I love the symbol of the anchor, right? The symbol of the anchor that if you put it down in a boat, it can keep you steady in stormy conditions. Or if you're looking at, let's say, an anchor when you're rock climbing, that keeps you from falling, to your death. Or if you're the anchor in a relay race, you're typically the fastest runner there, right?
Correct.
So the anchor itself has a very powerful symbol. And because one of the owners of Ancorato, his background is Italian, we're looking for different ways that different versions of the term anchor, because anchor is a very popular term in financial services for those exact reasons I mentioned. And because of his Italian background, we look for derivatives of it within it in Italian. And Ancorato is what we found because it was so unique and different. But also because of his Italian background, I think it works for us.
I think it's beautiful.
You would.
I see what you gentlemen would mind as well, right? Your backgrounds?
Fella. You like that, Jim, right?
I do. All right. I guess we're getting close to the end, but
yes, we are.
At this point, can you give us a little bit? I think this is awesome what you had shared with us today. And I see a lot of pros to utilizing your company. The question I have is and I always have to look at the negative side of the equation here as well. The only thing I've foresee basically is tying the client's money up. So if they needed a cash immediately, not that we would put them into this investment with that purpose, but if they needed money, that's the only downside because it may be being sold at a bad time. Other than that, is there anything else that I'm missing?
Well, there's twofold. Liquidity is actually a very easy risk to overcome. These notes are 100% liquid. I had a client that made the request on December 31st. It was a small account, $46,000. It was a nonprofit. They needed money. And by January 2nd, we got them out of all their positions and got them their money back. A couple of the notes took a very small discount, but the majority of their money came back to them within just 1 business day. So we can definitely get liquidity for the clients. It's just a matter of what that liquidity price will be. Like I said, if they're
that's
fully
the
deployed
downside
and those
to
are
me.
longer term notes,
Right.
because of the duration left, they might take a discount on that. The other part of it is that the other risk associated with structured notes is that they are somewhat market tied. That's why I talked about the different underliers. And the reason why that's important. If you're an aggressive strategy that uses individual stocks, and although we might be choosing companies that we believe have good fundamentals, right? There's no guarantee that those fundamentals or the value of those share prices are going to remain what they are at the time of purchase. And we all know volatility in the market can be based off of a variety of reasons outside of our control. And because of that, if you're in let's say you're in one of our notes that has, let's use Tesla as an example. And it just happened that its maturity date was last week or during the time or the recent time when Tesla had a recent drop in value. If on maturity date, let's say it had a 30% principal barrier, but on that particular day of maturity, because of what's happened in the marketplace, the news, or whatever the case may be, Tesla dropped 35% on the day of valuation on the maturity date. Because it's now below its principal protection level, the bank at maturity only returns 65% of the original principal. So there is some market risk associated with structured notes. That's why our other two strategies don't use any individual stocks at all, because it's to mitigate the risk of that kind of drop in value.
Yeah, I
So
think
there is some market risk associated with structured notes.
Yeah, I think that's the beauty of you offering the 3 separately managed accounts and those approaches, because they counterbalance one another for sure. So that if a client or an individual investor wanted to utilize it, I mean, us as advisors would probably point them in that direction. Of course, as you also mentioned, it does depend upon their risk tolerance, whether they fall into a moderate or more aggressive or less aggressive. They're more conservative in their approach. But I do think that is what we would probably do in advising and recommending them to utilize your SMAs. Anyway, to wrap up, since we only got a couple more minutes here, so in summary, just give us a 1 minute summation of the major points that we should make sure that people remember.
Yeah, thank you. Number one, thanks for inviting me here to join. I appreciate that. I think a couple of quick bullet points is that structured notes can be a great way to complement your existing portfolio. Whether you want to create more income or create more growth, if properly vetted, they can be a great tool that you could add to a client's portfolio to achieve those specific objectives. However, they do have some very, very specific risks associated with them. So you want to make sure that if you're doing it yourself, that you make sure you fully understand those risks, or you select a partner, a manager that understands those risks already and already are have those as part of their underlying core philosophies with every note in which they purchase for those portfolios. Obviously, I would recommend us because we've been doing this since 2019. But I know there's some other great managers out there. But again, just make sure that as you're looking to achieve, nothing is without risk. And historically, when there's been anything bad regarding structured notes, is usually because advisors didn't fully disclose those risks. They may have over-concentrated to some particular notes that didn't turn out as originally planned. And because of the over-concentration, they put their clients' money at risk. And that's what I recommend is working and making sure you identify those risks and that you are very cognizant to not over-concentrate to any one note, to any one issuing bank, to any one underlier, and to make sure you diversify across your uses of structured notes.
That's excellent. Great wrap up. We really appreciate you being a guest, and we will be in touch with you in the future. Perhaps we'll have you back, to see how things are towards the end of the year. And once again, Pisoot, we appreciate your time and all the information that you've provided us.
Yep. Thank you very much.
Well, James and Jim, thank you so much for having me. I appreciate it. I look forward to catching up with you guys on another call.
Okay,
Sounds
great.
good.
All right. Take care.
Take care. Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com/disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy, engage in any financial transaction, and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor, or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only as of the date of the production or writing and may change without notice at any time based on numerous factors such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bellpoint Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.